Good morning. Welcome to a What's Up with the market status, international markets, Australian markets, some commodities, and we'll look at a couple of new indices today, which add to the bull market that we have going. Firstly, apologies for the later start. I just had a couple of technical problems. Right, before we get into this, I will tell you that everything, just a reminder, that none of the analysis I do here today is used in SPA3 Investor or SPA3 Trader, which are totally 100% mechanical systems, no discretion whatsoever on my behalf or anybody else's behalf that has any input into the portfolio, which is just the system, 100% mechanical system. I know other people that claim to be mechanical do apply some discretion. Now, none of this analysis is used in any of the public portfolios, nor do I use it for any of my own SPA3 Investor portfolios either. I'm 100% mechanical, and I precisely follow the systems as do the public portfolios. And I should tell you that everything we cover here today is general investment advice, not personal direct investment advice. Right, straight into the Dow Jones. What we have here is the breakout above this. This is the previous high, this dotted black line, which I'll make solid. It's been down and tested, so that becomes a previous resistance all-time high. That's why I've got it black and these others blue. These are all support resistance zones. This black one I used to show what was the previous all-time high. I'll leave it there for a while until we have a sideways moving market up at some higher level, and then I will make that the all-time high, and that will become a new support resistance zone, and I'll turn this one here into blue. That's just how I do my analysis, just to differentiate, so I can always tell where there are all-time highs, resistance levels that markets or stocks are trying to get through. When they do, that resistance becomes support. So the Dow Jones well and truly above that all-time high, and indicative of a risk-on market as we have the Dow Jones here. This is a relative strength comparison to the S&P 500, and in good raging bull markets, we tend to see the broader market outperforming the Dow Jones, the narrow 30 constituents of the Dow Jones. So that'll be a little bit of a theme today, because I'm going to go to two other indices that are even broader market indices, and then the S&P 500, and we'll have a look at what they're doing as well. So moving down to the S&P 500, there's the previous all-time high, broken out above that, a little bit of resistance. First visit up to this area from back here in January of 2022, and breakout, clear breakout, new all-time high, close again on the S&P 500 overnight, and nothing more to add there. It's certainly in the channel, the rising channel, getting up to near the top. When we get up there, or it doesn't have to wait till it gets up there at any sort of level now, you could expect a retracement. The last retracement was a breakaway gap down, followed by a breakaway gap up. And this is indicative of bull markets, one that you should definitely have exposure to. What I take out of the cumulative new high, new low, that's 52-week new high, new low, is that this is rising in unison with the index rising, and just got two touch points here, a little bit of a gap forming here. Because there's 500 stocks here involved here, you can see that it's not a volatile. That's the gray line I'm looking at. It's not a volatile line. It's so just a little bit of a gap there is showing more strength. So not huge, but something to take note of. The New York, this is the cumulative advanced decline line. Similar is the so just checking the date, is that this is rising, so there's no early warning signs there, which is why we look at this. So we can see that the moving average, everything is rising in unison like it should do in a bull market. This is the number of stocks that are above their 150-day moving average. Same thing, high component up at the 80s. When do we get to zone, if you like, that's starting to send off warning signals of being too bullish? Well, it's a breadth of market indicator when we get above this 85 line typically. But you can see stocks can start dropping below the 150-day moving averages, and it doesn't necessarily mean that price is going to fall immediately. There's the S&P 500 down here. So it is just an early warning just to keep an eye on. At the moment, that's not happening and not in overbought zone. This is the US dollar index. This, to me, is the key one we need to keep an eye on. This is where the early signs are going to come from. So what I've done here in the middle chart is a relative strength comparison between the US dollar index and the S&P 500. So we're comparing the two as a ratio to see the gradient, if you like, of which one is winning out. So when this blue line is rising, is rising at a greater gradient than what the S&P 500 is, and when it's falling, stocks are outperforming the US dollar index. And effectively, this smoothing index, the rate of change that I've got over here, is just it's an indicator of an indicator. So, and I've put just to make it easy for you to see, is that when this is falling, denoting that the stocks are outperforming the US dollar index. So that is showing that it's what we call risk on. So that started around about there. And even though and you can see that the gradient that is rising, you can see that now, just zooming in a bit over here, is that the stocks are starting to outperform US dollar. A little bit of an uptick on the most recent bar, but this is bullish. This is bullish. So what we want to look for is a rising US dollar, and look for these are moved a bit. Is look for that kind of situation occurring there with the US dollar. Stocks are rising and US dollar starts. Oh, that's in the wrong place. Sorry. I just need to check what I've got saved there. That's over there. What we're looking for is that to start happening, and not happening over here yet. So all systems go still. Bullish sign there. That is a sentiment indicator that we use on stocks to US dollar ratio. Right, here we're looking at this is the XLY versus sorry, I've just got some stuff in the way there. Yeah, this is growth. This is the Russell growth versus the Russell value. Same thing happening here. A little bit of a down, showing that value is starting to outperform. Starting to outperform growth. Just looking at the raw line, the moving average is still rising, slightly starting to flatten out. But this relative strength, the Ciroc of the relative strength line, is really what we're looking at, just to smooth these out so we don't react to the daily bounces of that relative strength line. You can see that the down here, S&P 500 is still rising. So no early warning signs using growth versus value as a sentiment indicator, and nor is there here with using discretionary versus staple sectors, or I'll use the spiders to show this. This is the XLY, discretionary versus XLP staples. And whilst flattening out here, discretionary flattening out and raw price action, relative strength starting to dip a little bit, but I'm using the smooth indicator here. So we're looking for this to start happening, the smooth indicator to start falling as an early warning sign, not happening yet. So supporting the bull's case. This is put versus call ratio on the on equities. So this is options, put call options on the equity on the S&P 500 stocks, and risk on as well. We're looking for a little rise, a red one like that, to give us some early warning signs. You can see down here, this is the S&P 500. There was an early warning, and we think we had about a 10% fall ultimately in the S&P 500 there. So we're looking for those early warning signs. None here. Calls still winning out over puts at this stage. Right, this is yield, 10-year yields, treasury yields, a little bit of an uptick overnight. It's probably something to talk about, because that little uptick let me just zoom in a bit, was probably a little bit of a bigger bar. We had a bar back here that is quite a big bar, didn't break through, yield started falling, we had another big bar, and typically let me just put a value line here so you can see, is that when stocks rose, when treasury yields rose on the 13th of February, you'll see down here at the bottom on the S&P 500, we had 2 days of weakness. And then the variables at all controlled, the market started rising again. But what we had here is we actually had yields rise, and we had quite a good rise on the S&P 500 on the same day. So that's also a little bit bullish. We know that there have been some announcements on what the Fed might do later this year, but certainly seeing those rise on the same day is a bullish sign. Right, what do we have here? This is the actual, this is a 20-year treasury. This is the bonds rather than yields. Sorry, I'll just get rid of that value line. And what typically happens is bonds, because yields and equities tend to go opposite directions, which means that when for yields to go up and stocks to go down, it means bonds should go in the same direction as equities. And what we're seeing, that wasn't the case here for a while. So there's a little bit of divergence there. And now we are seeing bonds and equities going in the same direction, except for that last bar. But looking at over a few, this is all happening like it should for a bull market in equities. The VIX, sure, we've got a little bit of an uptrend over here, higher lows and higher highs in the VIX over the last 3 months or so, but we still have a declining and flattening. I've got a 21-week, 105-day exponential moving average on there, and so still very low levels for the fear index as well. Right, the Nasdaq Composite, the laggard in this whole scenario that I've been painting for the last 3 or 4 months, has, for the second time, let's just zoom in here. There it broke above its all-time high. So the upper part of this dotted rectangle here, what I do is make sure that the upper part is on the previous high close, not high. So we're looking for a higher close than the previous close. And so that is at the close, going way back over here off the left. There we had a higher close, back into the range, another higher close, back into the range, and now another higher close. This is the third time we've had a higher close above the previous higher close. So not quite broken free yet, and certainly not a strong breakout yet, but certainly now joining the other indices, and we've been waiting for this index to do that. It needs to rise, come back, test, find support again at this previous resistance zone, and then keep going. That's what we're looking for the bullish case to continue, and stocks to continue rising. And here's the Nasdaq 100, well above, so it broke above what's doing what the Nasdaq Composite is doing now. The Nasdaq 100 did this back in the middle of December, so nearly 3 months ago, and tested. This is what we want to see the Nasdaq Composite do, come back, test, and then keep rising. So it's in this channel now towards the low end of this channel, and another positive night, not an all-time high again, but the large caps, Nasdaq 100 stocks rising, and there we had the risk on going back all the way to over here using the relative strength, and I'm comparing that to S&P 500. So when tech stocks do better than the broader S&P 500, that is a risk-on environment. Looking at new high, new low, cumulative new high, new low of the Nasdaq 100, you can see that's starting to rise now, of course, because there's 100 stocks here, and we need cumulative 52 weeks. So there's quite a lot of time in this breadth of market indicator. It is rising, which is what you want it to do. And we're looking, and what we typically look for in these breadth of market indicators is divergence. So there's no divergence there, nor is there divergence here in the Nasdaq 100, a cumulative advanced decline line. Right, keep going. Another breadth of market indicator, looking at the number of Nasdaq 100 stocks above their 150-day moving average, and that is right up at high levels, not at overbought levels, but continuing to rise as well. And there's the Nasdaq 100 down there. So no early warning signs there. Now going down into a semiconductor sector, which is a subsector of the Nasdaq, and or a sector of the Nasdaq. And we can see that this is an all-time high territory. And what I do here is I compare this relative strength line over here as comparing the semiconductor sector to the overall Nasdaq Composite Index. And where we have it underperforming the Nasdaq Composite, that's bearish. And where it's outperforming the Nasdaq Composite, that as a sentiment indicator is bullish. So we have certainly got semiconductor stocks outperforming the already quite volatile Nasdaq Composite. So why is the Nasdaq Composite lagging a bit, the Nasdaq 100 and semiconductor? Well, that's because the broader bottom end of the Nasdaq Composite, those stocks, the mid and smaller cap stocks, are not doing as well as the larger cap stocks. And we'll have a look at that in a moment. So risk on, certainly, with our smooth way of trying to get some indication, if you like, of what may be lying ahead of us. No tipping over here, no tipping down of the SIROC indicator of the relative strength. So no early warning signs there either. Sorry, I'll just look to see if there's any questions coming up. No, none at this stage. Right, which brings us to the All Ords. the All Ords, there is the all-time high close back there. So we've broken above it. Big down day on Monday and a little bit of recovery yesterday. And I haven't looked at the market today, but I suspect after what's happened in the US session that we're going to be at least not down, but probably up a little. And what we see in a risk-on environment is the All Ords in the Australian market underperforming the S&P 500, which it is doing. So typically you find in a bearish market for the S&P 500 is that the relative strength of the All Ords outperforms. What? Because it doesn't typically, not being as volatile, doesn't go down by as much as what the S&P 500 does typically, what happens there. So that is indicating risk on as well with that falling relative strength against the S&P 500. Okay, next up, looking at the Australian US dollar. This is in a downtrend, quite a long-term downtrend, but where we see strength in the US dollar index, we would typically see weakness in the AUD, USD, and that's what we had overnight, but this is still in a long-term downtrend. Bringing us to the Nikkei, the Japanese market, there's the breakout, come down to test. Now, I don't have a zone here. I could put a zone there, so that would be well within the zone if I had a rectangle rather than a line, but I will change that at some stage. But so it's come down and it's testing the zone, and really what you want it to be, I can probably pick that the zone would be somewhere around these bars over here, the high and low over there achieved. So it's in that zone. And now for this to follow the textbook is we'd see it rise above that line and above that zone and continue its rise, its price rise from there, much like the DAX has done. So there's the DAX broke above, first time breakout here in early December, sideways, so a bit of indecision, consolidation is probably a better word, tested the zone, broke out above those new highs, got a little bit more consolidation, and then a strong run up, and then a big positive bar here to another new all-time high on the DAX. So all of these markets are joining in. This is bullish market. This is a market that you want to have your money exposed to and should have had, probably 3-4 months ago. But certainly if you're not in it now, now's the time to be in it. The FTSE's below its all-time zone. And just quickly looking at the large cap stocks in China, well, here's higher highs, higher lows happening as well. So maybe China is going to join in as well. Certainly miles away from its all-time highs, way up over there. But even if we took this as a recent all-time high, that there is still a long, long way away from there. But so the Chinese market, the big laggard. Right, let's just have a look at two other indices, as I said I would. And for that, we'll go to here, which is the S&P 500 equal weighted index. Now, over the long term, the equal weighted index actually outperforms the S&P 500, the weighted index. And what is equal weighted? It means that stock number 500 gets the same weighting as stock number 1. And so this means that when this is doing well, it means that the smaller cap stocks, the lower market cap stocks in the S&P 500 are doing better than the larger cap stocks. So because this is lagging the S&P 500, the larger have obviously been doing better than the smaller in that index. But we've now had, since we last met, a breakout to a new all-time high for the S&P 500 equal weighted index, which means some of those smaller cap stocks in the index are starting to come to the fore. And I haven't got a relative strength line. Yeah, I should put that on. Or do I? Here we are, I do. Sorry, that's a base. It's not a relative strength comparison. I'll put that up for next time. So here we have another index breaking out to new all-time highs. As we do, I said I'd bring it to you, and it happened. The mid-cap. This is the mid-cap 400. So effectively, the way the S&P Dow Jones indices work, is we've got an S&P 1500 made up of an S&P 500, the large cap, S&P 400, the mid-cap, S&P 600, the small cap. Add those together, and you get to 1500. And the small cap, the dollar SML, has not made a new all-time high. I'll bring that to you when it does. But since we last met, the mid-cap has, which also explains why the equal weighted is also made a new high, because the smaller cap stocks in the S&P 500, as well as the next 400 in market cap below the S&P 500, are also making new all-time highs. So it's risk on. Now down here, we've still got the fact that the Ciroc is falling, and this is the relative strength line. I'm comparing mid-cap to large cap, is that mid-cap is still underperforming the large cap. So on a relative strength basis, what we want to see is the mid cap start outperforming the large cap, the S&P 500. And if that happens, that's the next sign of continuing strength in this market. Just to illustrate, let me just go back to the last secular bear market we had. So this is roughly 2007 on the left over here to 2013 over here. Now, you've heard me talk many times about the S&P 500. The start of the secular bull market that we're in happened late March, 28th of March, or the first week of April 2013. So that is this green bar over here. Now, note what happened. So during this, where the dotted black line is over here, that entire time, the S&P 500 was below its previous all-time high. So it was still in secular bear market territory. Whereas the S&P 400, there was its previous all-time high in 2007, resistance, 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 breakout. So the breakout to a new all-time high on the S&P 400 happened before the 500, but then it broke down into the range and then broke out over here. So now with the benefit of hindsight, you could say that the S&P 400 started its secular bull market on January 2012, some 15 months before, with the benefit of hindsight, obviously. How do I know that? Because it came back here, retested the support, which was previous resistance, which now became support, and broke up. So you can, with benefit of hindsight, you can go back and say that was the official breakout into new secular bull market territory by the S&P 400 ahead of the S&P 500. And this here is where the S&P 500 started its secular bull market, where it made its new high. So you can see that there are periods, and here's the relative strength line. You can see that there are periods, and all through the secular bear market here, coming out of the secular bear market territory. That's the base, the bottom over there back in March of 2009, where the whole thing started to get out of the to go from secular bear to secular bull. You can see that mid caps outperformed large caps in this entire time. So that is what we are looking for. And that probably was an indication of a change to a secular, from a secular bear to a secular bull. So now we are looking for the same thing to happen here. Mid caps have underperformed large caps. This is going back to March of 2023, and a little bit of a up over there, but now we're looking for mid caps, and that will really bring us a raging bull market on equities. And that would have to be one of the signs of leading to euphoria. Certainly no euphoria around at the moment, despite some of the obviously the long-term bears calling that this is the end of and we're going to have a long-term sideways market. But that's okay, because they always do that. But there are some more objective and even perennial bulls that have been calling this market and saying we were not going to have a new breakout. We were going to have sideways, for another 10 years. Which is, by indications of everything we're looking at the moment, that ain't happening. It definitely is not happening. So, and bull markets always climb a wall of worry. You are never going to find everybody saying time to get in, but the market will vote via price action, and that's what we've got to listen to. So cut out the noise and watch and listen to the market. Right, quickly onto commodities. We'll go through these pretty quickly. There's only one major one I want to talk about today, so I'll flick through the others, or probably two if we count Bitcoin as a commodity. I've got it in that watch list. It's probably not, but anyway, we'll leave that for another time. The commodities index, the CRB index, is in a slight uptrend, underperforming equities, so not too much going wild in the commodities index, which is dependent on oil and copper and some others. But here's the one, gold. Look at all these attempts. It was eventually going to get through, and it has, and that's a strong breakout. So what do we take from this? Well, we've got to keep an eye on it, and this means, so what kind of eye do we need to keep on? Well, let me just go back to 1978. Look at all data over here. And just look at some of the analysis. Now, where have we got to? I've got to go down to this one here. Oh, not that one. Sorry, the one above. This one. And you'll have this, so you can download this and look at it in your own time. And why is this breakout important? Because it could be, it doesn't have to be, but it could be an early sign of a moving from a secular bull to a secular bear. I've been saying that a few times now, but let's just put that into context. We shouldn't, henny penny run for the hills. But where I get that analysis from is this is 1978, a base 100 reference. So it's both gold. So gold is the green and red, high low price action. Blue is the S&P 500 cash index. And so the first question we've got to answer when we see gold break out like that is can gold and equities rise at the same time? And the answer to that is a definite yes. But to qualify me saying let's keep an eye on it, because it could be an early indication of moving to a secular bear market, which everybody, all these even perennial bulls have been calling, is this here, is that during this secular bear market of the S&P 500, which lasted about just over 13 years, is gold did its thing. Now, so gold is going to go mad when we do get into a secular bear market, which we're not in at the moment. We actually have broken out in the continuation of the secular bull market, which I covered in that 6 month analysis that I do. But what we can do, it can see even in a secular bear market, is equities rising and gold rising. We can even see that when we have a secular bull market in equities. This is the big secular from 1982 to 2000 to 2000. That's 2000. So that was an 18-year equities bull market rising over there. The breakout here was in October 1982. Is that even in a rising, raging secular bull market for equities, we can have gold and stocks going up like it happened there. You can see in small parts over there. So it can happen, and for many months, even a year or two at a time. So we don't want to, as much as we do want to look at gold as a potential early warning signal, because it takes 2 to 3 years to find out that we are actually in a secular bear market for equities. It's a hindsight thing. It's very difficult to tell on the day. You can do it far easier when you go from bear to bull, but going from bull to bear is very difficult. How do you know here, for instance, that this here wasn't just a continuation, just a retracement? And it's typically you wait until you get a 25, 30%, and then it keeps going. But when you hit the 50%, then you know that you're in a secular bear market. But you need to find that out. Obviously, you need to have some kind of regime in place through timing of markets, timing of your portfolio, to ensure that you don't wear the whole 50%. And there we had 2 50% in a row. So just putting that into perspective, we're going to keep an eye on gold. Here are other periods here in a secular bull market where we had gold and equities rising. So there's plenty of evidence that they can both rise at the same time. But we will still keep an eye on it. And gold bulls will be very, very happy with that. And there's obviously lots of ways that you can profit from gold. There's plenty of stocks and ETF, and there's an ETF around as well. Silver is not near that. It will tend to follow. When silver starts outperforming gold, that'll be really bullish for commodities, not happening at the moment. And copper as well, languishing, has broken out of this big downward trend, but underperforming equities. So just keep an eye on that. Gold. So it's underperforming gold, and as is oil as well. So oil equities ratio is equities outperforming oil, and it's in a slight uptrend, but these lead into the CRB index, where we could tell whether commodities in overall are in a bull market or not. They're not going down, but they're kind of hanging in there. Right, on to, I thought I'd updated this, onto Bitcoin. There's the previous all-time high there, so I'll just drag that across, and that will be updated, and Control S to save, and you can see that has had that's a breakout to a new all-time high. The Ciroc 29.6 over here did a good job of getting us early enough, so it's had 2 really good trades, one, and now we're still in one if you were using that as a trading Bitcoin, but that is all-time high, as is Ethereum. Hasn't got to its all-time high yet. It's not far off it, but this is a bull market in cryptos, and I have a small allocation. I don't trade cryptos, just to declare that. But I do have a small holding just in case it goes ballistic and gets to what people say it might get to. But I have exposed some of my wealth to Bitcoin, and I buy and hold it. And at times, if it gets a bit euphoric, I might look at taking some other kind of position there. And I've done some paper trading on 26 Ciroc 26.9, and it's worked quite well, as I know a lot of customers do as well. Right, and that hint and tip came from a previous customer. I didn't work that out. Right, just looking to get through commodities here. Uranium having a bit of retracement, as it should, but been a very strong price action, behaving right close up to the upper channel line of that. And you can see the gradient has been pretty steep, and it is outperforming the URA ETF. So you wouldn't have got that much growth out of the uranium ETF, but some of the stocks would have done pretty well. Iron ore has met some resistance, fallen back into this range, and it's still a high. Still has, so you could rate that depending. I'd have to look at my swing charts, but that looks like that would have been a lower low there. So it's actually, a higher low than that one, but now a lower low than that, a trough forming, or hasn't yet formed, so it could still go lower. So it's iron ore coming off a bit, and coal, thermal coal has found support. It looks like it's found support at this level over here, which is around about 100, I think, and it's now in this range, and it's good to be forming a base between in a range, because it doesn't really typically form. It gives us a bit more analysis, a bit more of a base to work our analysis from. So commodities not really taking off. Gold copper not yet. Gold would obviously be leading into some of the smaller golds being a bit more volatile, and we'll see the honeypot bees come rushing in, and you'll see volumes go up. They did that with lithium stocks. Now they can do that with gold stocks. There's always one that's going. So if that's your bend, then it's probably going to be gold stocks for a while, and it has probably been uranium stocks for a while as well. They might come off a bit. Now we can the honeypot bees can go to the golds. Right. So the theme here really today is that we have made a new high in the equal weighted and the mid cap indices, and that is where the action is. What I'm going to just quickly finish on, if there are any questions, is go to the comp, and what we're looking for here is the Nasdaq composite to really break away here, and the smaller cap tech stocks to start joining the party as well. Right, Don just saying gold can rise at the same time as shares, but strongly making a new all-time high seems significant. Is it related to the Bitcoin strength caused by other issues? Yeah, that's a great question, Don. Why don't we just go to under my Bitcoin and look at the Bitcoin to gold ratio. And this was a question that did come from somebody. I can update this chart now. We can do it live. And what I've got here is the black trend lines on here. How far have I gone back? Around about there. The black trend lines on the upper and lower charts. So the middle chart is a relative strength line. So that's showing the ratio between gold and Bitcoin. And Bitcoin is going to be a bit more volatile. But effectively, this here rising blue means Bitcoin's outperforming gold. And obviously falling, it means that Bitcoin is underperforming gold. But typically that under or overperformance comes from the volatility in Bitcoin, because when it falls, it falls. When it rises, and it does so more than what gold does in either direction. But so the black areas, let me just zoom in on a couple here, as you can see that they are in unison. So there's definitely a correlation between the two, and there we can see black. There are two red points when they were out of sync. Now the two blacks, more reds, but there are certainly more blacks than reds. So what Don is saying is the rise in Bitcoin is what is causing the rise in gold, and it could be. Now this obviously Bitcoin's only been around for 10, 11 years, and you could probably discount the first 3 or 4 years of that price action. So pretty short compared to gold, but there is certainly enough. And when I've done this analysis, you'll see, and you can pull up this chart and see, I've tried to start these trend lines on the same bars. So we're talking relevant periods of time here. But you could do that. So if we did this analysis now, we'd be doing a trend line here, black on black, that's rising. And we'd be doing one down here. So what I do is I put the value line there and do another trend line here and try and start that there. And certainly you can see it's almost going bar for bar at the moment. So there is correlation, and in between, I could, if I wanted to, do a red line there where they were probably a little bit out of sync, rising there, falling there, but that could certainly be the answer, Don. Could certainly be the answer. So I can just Control S, save that for next time. But yes, so good point. Good point. It could be, in which case it's not an underlying fundamental reason for gold to be rising. And why would gold rise? Typically as a hedge, and also typically as because lots of gold and jewelry and all that sort of stuff. So those are typically the fundamentals behind gold, but this could just purely be a speculative following of Bitcoin. But don't know enough about it, and we have to keep an eye on it. So thanks for that question, Don. Are there any other questions anybody would like to ask? If not, pleasure, Carlo. So we're keeping an eye on the Nasdaq Composite over the next 2 weeks to see if that joins the party, and also the SML, this mid cap 600, sorry, the small cap 600 is also one to keep on. It's still some fair way from its all-time high, but I'll be keeping an eye on that. No more questions. Thank you for your time and attendance. And always, I wish you consistent and objective and peaceful investing and trading.